Wealth management is not just for the wealthy. Everyone is entitled to their best retirement possible. Welcome to The Retirement Engineer with Jim Kruzan, your path to a bigger, bolder retirement. Brought to you by Kaydan Wealth Management, a firm that specializes in serving the mobility technology industry. In this podcast, we help you maximize your resources and engineer your best retirement through a process-driven approach so you can get the little things right. Drawing from years of expertise, Jim and his guests will simplify complex wealth management strategies and explore actionable ideas to help you protect your hard-earned wealth and take control of your future. Now, on to the show.
Today, we're digging into a topic that you don't often hear other advisors discussing, yet it's one of the most impactful tools in your financial arsenal, the tax pro forma. Imagine having the power to foresee your tax liabilities and make strategic decisions to avoid those dreaded surprises. I'm Patrice Sikora, alongside your host, Jim Kruzan, and we're going to get into this often overlooked strategy that can give you the edge to transform your financial planning. This is a conversation you won't want to miss. And Jim, we also have a special guest with us. Why don't you introduce him and briefly overview the importance of today's topic?
Sure, I will. Actually, our guest, this is the second time on our podcast, one of our team members, Dylan Stewart, and I'll get into a more formal introduction in just a second. But we're really excited about this topic. I've been doing this quite a while, 4 decades. And I can honestly say over the course of the last 40 years, when I look at how we work with clients and how other firms tend to work with clients and in the industry as a whole, there seems to be way too much emphasis on investment product, investment strategy. That's typically the extent of the relationship one client would have with an advisor. But really, if you're trying to build a bigger, bolder retirement, if you're trying to have more or be able to do more with the resources you have, one of the best ways to grow that wealth, and I said grow wealth, not better rate of return, is by concentrating on a myriad of other tactics, techniques, and strategies that are beyond the scope of just simply what is the investment and how did it do. And one of the biggest drivers, one of the biggest levers that could be thrown is that of tax management. Simply put, the less taxes you pay, the more resources you retain that are then able to be used or reused for further growth, further opportunities, further experiences. In our practice, we use heavily this idea of a pro forma. We find it incredibly useful in identifying where we think taxes may be, and that provides the baseline for all kinds of other meaningful discussions that we can have in the future. And I'm pleased to have Dylan Stewart with us today. Dylan is a team member here at Kaydan Wealth Management. He's a wealth manager here at Kaydan Wealth Management. And in addition to being a CFP, a certified financial planner, Dylan's also a CPA, and he leads the effort in producing the pro formas that we use as advisors in conversation with our clients. So Dylan, welcome to the podcast again. I'm super excited about this topic, and I know it's something that you have a ton of experience in. So welcome.
Thank you, Jim. Really appreciate being on the podcast again. And I am equally as excited about this topic. Definitely something I enjoy spending a lot of my summers and falls working on to make sure that clients have an impactful conversation in terms of any of their tax situations.
All right, very good. Why don't we talk a little bit about what a pro forma is? If I were to define it, I would say simply it's just a projection of an individual's tax return based on not only current but anticipated income, any deductions or credits that they might have. It can be done literally on a back of a legal sheet of paper, or it can be done more formally in spreadsheets, again, depending on the complexity of the situation. The purpose of this, at least here at Kaydan, is to create this baseline where we can kind of project what the year will look like. and any other planning tools or techniques that we might want to use. Should a client have a large purchase? Where best to pull money from? How best to align and structure cash flow in one year given another? And also, should there be discussions about Roth conversions or other types of tax strategy? It gives us a really good idea as to just the degree to which, the extent to which we can convert without creating a whole nother mess of additional taxes, fees, or penalties. So it provides an incredibly strong baseline. At the end of the day, we feel it's far better to have these conversations real time on an ongoing basis with clients than simply doing a quick review from a historical point of view at the end of the year. It's just simply way too late. So Dylan, since you are the guy at the firm that builds a lot of these really quite detailed and complicated tax pro formas, why don't you share a little bit about what are some of the essentials and how we use these as related to our clients?
Thank you, Jim. Yeah, so with the tax pro forma, there's quite a few big things that it really helps clients with. Probably the most important is avoiding surprises. Any unexpected tax bills are definitely a pain to clients, a nuisance. There may be some penalties, late fees, what may have you. So kind of projecting kind of quarterly and yearly tax liability to avoid any of those penalties is extremely impactful to ensure that clients know that not only their investments, but also their taxes are being accounted for and handled well. Next, as Jim already touched on a little bit, optimizing financial decisions. Help in making those informed decisions in difficult topics, such as, when to time their income, when to do charitable contributions, though those vary year to year, when to take retirement plan withdrawals. And in our tax pro formas, we usually include kind of 4 major things. Firstly, last year's tax return numbers to kind of act as the foundation and starting point for building out the current year's tax pro forma. Secondly, all the different decision points. We have columns for, what if we didn't do anything this year? What if you buy that new car? What if we do the Roth conversion? What if you need, money for a down payment on the house? What if you want to cash in those U.S. savings bonds? All things that kind of see how that can impact your tax situation, your tax liability this year. 3, a projection into the future once Social Security and RMDs are turned on and you have much less tax flexibility. The government, they force some income into the future. So basically, after you retire, before those things get turned on, we have a lot more ability to manage that flow of income, and we'll definitely be able to help make those decisions regarding that. And then fourthly, estimating tax overpayments and underpayments. We get our clients close to ensuring we avoid penalties, surprises, any of those headaches come the end of tax season. From there, another important thing is ongoing tax planning. Many tax accountants are simply historians. They take your W-2, their 1099s, kind of after year end to determine how much, refund or underpayment that you should expect. But the problem with that is you're not doing any planning. You're just doing kind of paying or getting refunded your money at the end of the year versus understanding where all your marginal tax rate, where all of your tripwires, your IRMA and what may have you, that allows us to get a plan in place so that you don't have any of those surprises, kind of that big thing that we're trying to avoid. In fact, I recently spoke to a client maybe a week and a half ago where in 2022, they had a $21,000 surprise tax liability. It's very frustrating. Now they've got to change a bunch of stuff around for this year, figure out where to get that money from. And quite honestly, it's very unsettling to have that much money that's owed by the client to the federal government. So in the tax pro forma last year, we made sure to include a bit of a cushion, allow for a small refund come the end of the tax year, and like I said, to avoid any surprises. And Jim, you wanted to mention an example as well?
Yeah, there's a number of examples that I can think of just off the top of my head. One of the really interesting things is as we're working with clients, and typically we look at harnessing a lot of this income and getting an idea of capital gains and those kinds of things a bit later in the year. we noticed that we were doing a pro forma for the first time with a client, and the client effectively used TurboTax or something the year before to prepare their tax. And as we were looking at the prior year's tax statement, realized that there were a number of things that weren't reported. There were some conversions that were done that weren't reported. So there was an understatement of taxable liability. So we were able to identify with the client that, hey, your filed tax return is incorrect. You're really going to need to file another one in the hopes of avoiding some additional tax penalties and whatnot. Very appreciative. Now that we're handling the pro forma, somebody else is doing the filing, we shouldn't expect to see those kinds of problems. And then in another area, and again, tax laws change quite a bit. We'll talk a little bit about that. Right now, if you're in a 12% bracket, you pay 0% for capital gains, which is hugely impactful. So being able to run pro formas, get an idea of what taxable income looks like, maybe we shut some income off in one area and take it by harvesting gains in another so that we have the ability to keep them in a 12% bracket, allowing a lot of that capital gains to be taxed at zero, putting them in a significantly lower bracket than they would have been if they just took all the income they needed from their 401k or IRA, as everybody is led to believe that's what they need to do. In retirement, remember, we live on cash flow, and that doesn't necessarily need to be taxable income. So it's important to be able to work with clients ahead of the time, real time, to be able to provide those types of suggestions and counsel. Really important. You know, Dylan, you just spent the last several minutes talking about why pro formas are so essential to clients. And I hope a couple of our examples also kind of give folks an insight as to why this is something they may want to consider doing as well, or certainly question why these things aren't being done for them on a regular basis. Let's talk for a few moments about how we might be able to effectively use a tax pro forma. What do we need to do to really start to work with clients and set one of these things up to have meaningful conversation?
And thank you, Jim. And with that, gathering information is one of the critical and crucial components as it relates to tax pro forma. Accurate data collection is vital to making sure that we don't simply have kind of garbage in and garbage out. So when building out one of these tax pro formas, I'll often almost always give a client a call, make sure to kind of ask about their income for this year. Granted, I have last year's tax return information, so it starts off as a good kind of foundation for me to ask those questions, but just to make sure, I've had a lot of clients where they'll go through and they'll sell a property or cash in a U.S. savings bond or something that had I not brought up those questions, I wouldn't have known about, and it would not have been a part of the conversation. And then also, any of those changes in expected income, did they turn on Social Security? Did any pensions start? Any of that pertinent information to making sure that we're getting all the income captured so that any decision points have that strong basis from which to build out. Next, kind of data security, which is an absolute must, especially now where we're in a time and an age where a lot of folks are having their information, their identities stolen. Making sure that all of our clients' information gets received and retained appropriately is of extreme importance. We help to ensure client data is secure by having them upload their tax returns and pay stubs to a secure link or the Raymond James Vault, or even by, mailing it or dropping it off to one of our locations, making sure they have full confidence in our ability to kind of manage their data, their private information, and for us to be able to use it as part of these tax pro formas. And then using software tools. So now, as Jim alluded to before, kind of using Excel still is the standard in the industry today. There are some software tools that are coming onto the market, especially with this big boom in AI, artificial intelligence. And I think at a point in the future, we'll get to a steady state where using AI might be more impactful, but I still think we're several years away from that, because that big gathering information, kind of giving a client a call, understanding and having that phone conversation to understand where they are this year is very impactful, because many of your AI tax pro forma software tools simply do a screen scrape of last year's tax return and then apply this year's tax laws to last year's tax returns, which is just normally missing out on so much income and different things. Because for most folks, unless you're well into retirement and in a steady state, for most folks, 1 year's income looks often very dissimilar to the next, especially in those extremely important planning years, kind of from retirement until Social Security and required minimum distributions are turned on. So those are definitely important things to consider when learning kind of how to use a tax pro forma effectively.
Great, thank you. Yeah, if you think about it, if the average, although the trend line is extending, so people are now working a bit longer than they did, let's say 20 or so years ago. But the thought is, if somebody's retiring in their early 60s, they may have a 13-year run before all the spigots are really turned on. Required minimum distributions at 73, Social Security at 70. So as a result, that 13-year period is really that golden period for tax planning where we can make really impactful differences by really concentrating on how we can drive down taxes, not only during that 13-year period, but what actions we're taking during that 13-year period that can have meaningful repercussions in the out years. And it's really, really important to consider those out years. What do things look like when all the spigots are turned on? And people are sometimes aghast, certainly surprised, that the tax bracket we're projecting when all the spigots are turned on, when there's very little opportunity for change or adjustment or planning, might be quite a bit higher than the bracket that we have them in during those first few years of retirement. So as wonderful as pro formas are, there certainly are some challenges. And one of the biggest challenges is just simply estimating, Dylan, as you alluded to, annual income. It does change every year, and it changes because of a variety of reasons. One's pension, if there is such a thing, may be steady and stagnant year to year. In some cases, if you're an educator, you might have a little bit of a cost of living adjustment every year that creeps up. If you're already receiving Social Security, there's a cost of living adjustment on that as well. In addition, there's a myriad of other things that can happen that drive income as well. So it's important not just to harness last year's data and assume that's what it's going to look like this year, but touch in with clients whom we're doing pro formas regularly throughout the year. By late fall, and unfortunately it's later in the year, but by late fall, we've got a pretty good idea as to what distributions might look like off of mutual funds and such. Even though those distributions might not get paid out until late December, we've got a pretty good idea of what they will look like, as firms tend to inform advisors ahead of time. What other advisors do with that data when they get it, I have no idea. I know we use that to kind of project forward. And there can be some other things that affect that distribution over the course of the year. If you generally have a really bad market year, there might be a lot of redemptions. And that year of redemptions, any realized gains that the funds may have had have all been, or any realized losses the funds have all been soaked up by the harvesting of those gains. In the next year, they don't have nearly the tax lowering tools available to them, so distributions might be a bit higher. This past year, there was a very prominent mutual fund company that had a tax managed fund, which is a fund that concentrates on reducing taxable income. All the gain is deferred as capital gain. And the fund elected last year to close the fund and transfer those assets to another fund. That was a taxable distribution. So for many clients, there was a significant amount more capital gain than what we would have expected as a result of that. So it's really, really important to look at these things and have these communications. I know this is going to sound somewhat disingenuous, but it's also a really major reason why we certainly prefer, with respect to our clients, to have all of those types of investments that might throw off income kind of centralized and consolidated here with us. It's a lot easier for us to go online, have access to, and look at exactly what the tax consequences are real time, anytime we want to, as opposed to having clients provide statements to us regarding investments that are sitting somewhere else outside of the firm. It's just not efficient. I know many clients feel that it's a way of diversifying. But at the end of the day, I think the product you get, the service you get, the degree to which you have the ability to tax manage is far less effective. I have an example, a client with a sizable amount of money had money all over the place. She had a very large account at Vanguard. She had another very large account at Fidelity and another large account somewhere else. And she would meet with these individual advisors, as she had one at Fidelity and Vanguard and elsewhere, every year, and they would tell her how wonderful she's doing and this, that, and the other thing. And it was more of a pleasant conversation than it was anything strategic or tactical. She's referred to us. We take a look at everything, and we realize that the Fidelity account has been throwing off a significant amount of taxable income to which this woman absolutely does not need, and more importantly, shouldn't be paying taxes on. And then in the Vanguard account, which was mostly bonds at the time, everything she had sizable losses in it, which is natural considering what was owned. But nobody is suggesting to her, hey, maybe we take the losses in Vanguard and offset some of the gains at Fidelity to dramatically reduce your taxable income. Running that through a pro forma and showing her what those adjustments would be and what changes it would make to her were incredibly impactful. And now we're presiding over everything, managing it, and putting her in a much lower bracket than she would have been in otherwise. So estimating income, where it's coming from, is very important. And then obviously there are changes in taxation. We have to deal with that. Right now, when we project out and say, hey, when you turn all your spigots on in 8 years, here's kind of what that looks like. We can do it one of two ways. We can either assume that the current tax situation, the Trump tax cut, is still available to us, or we can assume, well, what if that gets sunsetted out and we remain back to what we had before, where your personal exemptions are lower and the marginal rate is higher? What would that look like? Having those discussions can be eye-opening. So, what are the major steps that we need to consider? What are some of the things that we need to do? First and foremost, if you're a client of the firm, rest assured that we do an awful lot of this stuff kind of behind the scenes, and many of you are aware of the conversations we have every year. But if you're not affiliated with the firm and are working with other advisors, really question why maybe you haven't had that type of conversation. It all starts with a complete review of what your tax situation looks like, and also kind of where assets sit. We're really familiar with and believe it's really important to consider asset location: tax-free, tax-deferred, taxable. If you're not working with an advisor, don't kid yourself into thinking that you're saving all this money. More than likely, the work that you do with an advisor pays benefits far superior to what the carrying cost is. And there are a number of studies done, in fact, one from Vanguard itself, that suggests that working with an advisor can add 2 to 3 times the cost of working with an advisor in terms of wealth creation. Not rate of return, but saving on taxes, using cash flow, and just being smarter about the resources you have. Dylan, did you want to add anything to that before we wrap up?
Yeah, and to piggyback on that thought in terms of working with a professional to kind of engage with these tax pro formas is having someone else that can look and see if you get any of those letters from the IRS. Hey, we feel you've mishandled something. In fact, this morning, I had a client reach out to me and say, thank you so much for helping in terms of a letter that the IRS recently sent. We were able to kind of have a tax pro forma that explained all of our different income items. We were able to go through and kind of support everything and more or less push back on their stance. And just with anybody, I mean, the IRS, they're run by a bunch of humans, and humans are definitely fallible, capable of making mistakes. So having someone in your corner that's able to kind of not only calm the situation down, make sure everything gets addressed and handled, but then also someone to leverage in terms of responding to the IRS, kind of directing you one way or another in terms of what that conversation should look like, can provide a lot of kind of relief and stress reduction for clients when working with a professional.
Great input. Thank you very much. Well, there you have it. Pro formas are important. They're an integral part of the wealth management structure, and they certainly help to preserve resources that can be used for much more enjoyable purposes. Thank you.
All right, then as we wrap up, remember a tax pro forma is more than just a projection. It's your roadmap to smarter financial decisions. By reviewing your tax situation and consulting with a professional, you can take control of your financial future and avoid those year-end surprises. If you found this episode helpful, please subscribe so you don't miss future episodes and share with someone who could benefit. Follow @Kaydan Wealth on social media and let us know what you think in the comments. Your feedback and topic suggestions help us improve and make a bigger impact. Thanks for supporting our show.
Thank you for listening to The Retirement Engineer with Jim Kruzan. Click the follow button to be notified when new episodes become available. Visit our website at www.kaydanwealth.com or give us a call at 800-638-6900. The information covered and posted represents the views and opinions of Jim Kruzan and this episode's guests, not necessarily those of Kaydan Wealth Management. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.